Hey everybody. Tuesday night in Europe. I am back from a day of presentations. I've been speaking at an investor event with the Skagen funds in Copenhagen. The theme really has been about asset allocation, uh, valuation stories, very much both in the fixed income and equity markets. Um, but during my presentations today, I did a couple. Um, I spent a lot of time reflecting on the recent turmoil, both in the Eurozone and in emerging markets, something I've been talking quite a bit about recently. I got a lot of questions about it. And as I was talking about it, I realized the way I talk about um, the problems we have seen in, for example, Argentina or Italy or Turkey recently, um, is emphasizing the debt issue a lot more so than I normally have been doing over the past decade. When the crisis hit in 2008, it very fast became clear to me that what we were facing was a monetary crisis. It was not a debt crisis, it was a monetary crisis that caused a contraction in nominal GDP, particularly in the US and in the Eurozone. And the contraction in nominal GDP then in turn caused a debt crisis. When nominal GDP collapses, your debt servicing costs rise at the same time, your debt to GDP ratio spikes, so you get both public finance and private sector debt crisis. But it's a consequence of the monetary tightening that caused it. That's essentially been the market monetarist story about the Great Depression. 10 years on, however, I think things are slightly different. When we look at some of the things we're seeing in global markets, it doesn't mean that we can't get the same kind of monetary shocks. But I think what is notable now is that some of the countries being affected by the recent jitters, I wouldn't call it turmoil, I just did, I guess, but it's more jitters, are countries that came through initially through the shock in 2008-9 quite well. Turkey, for example, South Africa. Obviously, Italy didn't, but that's a separate story. But among the emerging markets, we're seeing some emerging markets jitters now. And emerging markets really came through early part of the Great Depression, Great Recession quite well. Turkey is a good example. When crisis hit, interest rates were quite high in Turkey. The Turkish central bank slashed interest rates. The lira dropped very significantly, very sharply, and as a result, the Turkish economy recovered very fast from the initial shock. As far as I remember, the Turkish economy was growing around 10%, real GDP growth around 10% in 2009-10 after recovering from the shock. So it's a very swift recovery. And essentially, there wasn't any problems in Turkey and hasn't been until recently. Obviously, quite a bit of currency volatility, but overall, no major concerns in terms of public finance sustainability or anything like that. Rather contrary, Turkish public finances have looked good all through. And if you look at Brazil, Brazil came through quite well. Obviously, a lot of political issues in Brazil over this 10 years, but overall, again, no debt crisis, a political crisis, yes, but no economic crisis. And the economy has not grown very strongly at all. But there wasn't this crisis, this collapse, financial sector problems, the public sector debt. Rather, we come through again. Russia, same thing. We have a Crimea. We have all kind of things. We certainly had distress in 2014. But again, overall, we have not really in any way moved close to the abyss in any of these emerging markets. So all these relatively large emerging markets essentially have come through the Great Recession quite well. And so what is playing out now, I think, to some extent, is these countries are to some extent running out of luck. So what luck am I talking about? Well, first of all, when the crisis hit, in most of these countries, interest rates were, for natural reasons, quite high. inflation targets are significantly above what they are in developed economies. So rather than being let's 2%, they're rather 5%. So for interest rate targeting central banks in emerging markets, it was easy to slash interest rates a lot. A lot of them had floating exchange rates. So contrary to earlier emerging market crises, the currencies just weakened instead of being stuck in some fixed exchange rate regime, which caused a monetary contraction. We didn't see that this time. So this time around, emerging markets had come through relatively well, at least initially. But I'm increasingly feeling that that it's becoming more and more challenging for these emerging markets. And the reason is that we essentially now in the long run for emerging markets. So think about it as 2008 being an external shock, and you offset that and you don't get the crisis. Debt levels are, in overall public debt levels are low in many of these countries. For example, Russia and Brazil have quite low public finance debt and public sector debt, and so has Turkey really. Argentina is not the case, but the others at least have. And so when crisis hit, that wasn't a problem. It didn't become a problem because you had monetary response to the external shock. Nominal GDP growth essentially had been holding up quite well. Even in a country like Brazil, where real GDP growth has been weak, you've had a 5% nominal GDP growth, so you didn't create the kind of debt deflation spiral that you saw, for example, in the Eurozone, where a drop in nominal GDP causes debt to GDP ratio to spike, which in turn leads to fiscal tightening, which pushes nominal GDP further down, and so forth. So you haven't seen that in many of these emerging markets. However, if you look at it now, it seems like we are being in a situation where global bond yields have been inching upwards, just ever so slightly, not dramatically, but sliding upwards. The dollar has been strengthened since mid-April, so liquidity is tightening. Effectively, we're also having monetary tightening in China and in the Eurozone. If you look at our monetary indicators, both the Eurozone and for China, monetary conditions have indeed been tightening over the past 3, 4, 5 months. So globally, we're probably moving in the direction of tighter monetary conditions. Never good for countries with debt. But are these countries really having debt problems? Take Russia. Public sector debt in Russia is like 15% of GDP. That's not a lot. Yeah, but a decade ago, it was 7-8% of GDP. So public debt has doubled in Russia as share of GDP, gross public debt. Why is that? Why is that? Well, because those larger emerging markets that did quite well before 2008 really was in a catching up reform story. Everything come perfectly together for these countries. After 2008, that has changed. It has changed because in many countries, the rulers have stopped the reforms. In Turkey, in Russia. In Brazil, never had reform, but Brazil was quite lucky with the commodity price cycle. Argentina has been struggling constantly. So initially, these countries that didn't reform themselves or where reform stopped, real GDP growth just slowed. And initially, that we just saw then a response to that, having nominal GDP growth continuing to grow at the same pace, meaning inflation is gradually being moving upwards. That's the case of Turkey, of Russia, Brazil. Now we are in a situation in Brazil, for example, you have essentially no growth and 5% inflation. So how, if you then get public finance problems, because that's what you're getting in these countries, because President Erdogan, President Putin, they've been ruling for more than a decade, for 1.5 decades, nearly 2 decades. So they're running out of political steam. And they try to offset that by easing fiscal policy. We've seen fiscal policy being eased in a number of emerging markets. And that has been an attempt to spur growth, but it hasn't really helped. Underlyingly, trend growth in a number of the larger emerging markets has really disappointed in terms of real GDP growth. So when you then ease monetary policy, you just get higher inflation. That's good in the sense of ensuring that your public debt ratios do not spike. But when you have unsustainable public finances, as for example in the case of Brazil to a very large extent, then the market will have to expect that either you do something about your public finances, or you get your adjustment of your debt to GDP ratios by having higher nominal GDP. The only way you can have that is through easier monetary policy, and to get that you need to have a weaker currency. So when you have unsustainable public finances, you get these dynamics. And that's what we're seeing. We're seeing that suddenly interest rates that have been moving up, market interest rates, means that you comes around what we could call the threshold level, and I've been talking about this recently on interest rates, and then your debt simply just starts to snowball, and your debt projections move up quite dramatically. We've seen it in Brazil over the last 3-4 years, debt going from nowhere to around 20% of GDP. We have seen it gradually in Russia, and I think we might be beginning to see it now in Turkey as well, that suddenly your debt dynamic becomes unsustainable. That's easily explainable when that happens in Greece or Italy in a currency union where nominal GDP collapse. And then the solution is not necessarily fiscal, or maybe it's partly fiscal, but it's also monetary. But if you're in the long run and your nominal GDP is essentially growing as it should, and your public finances are unsustainable, and your growth is weak, then what happens is that your currency weakens, and then essentially becomes like a supply shock to consumers. It's just an erosion of purchasing power. So instead of taking away the purchasing power from consumers by taxing them more, you tax them through higher inflation. And I think that is essentially what is happening now. Fiscal adjustment has not taken place, rather we have had a lack of reforms, and then we are seeing some rulers, whether it's Turkey, Brazil, Russia, moving fiscal policy in generally easier stance, making public finances unsustainable when global yields are moving up. So that necessitates some kind of adjustment. So here we don't talk about a monetary crisis which turns into a debt crisis. Here we are in a situation where monetary policy is at a starting point maybe more or less on track. But then you get a public finance problem which creates implicit expectations of monetarization of your public debt, then causes your currencies to weaken, which causes inflation to shoot up, which causes an erosion of purchasing power. So instead of getting that tax increase, you get higher inflation. The outcome is the same, erosion of purchasing power for consumers. But that also creates a political problems for people like Vladimir Putin. What happens if oil prices stagnate and interest rates are still too high relative to what's the threshold value before the snowball effect kicked in? Then Russian debt will continue to increase. What will Vladimir Putin do in that situation? He'll have to tighten fiscal policy. He'll have to make budget cuts. We've actually seen some of that in recent years in Russia. So how do we manage that? The same in Brazil. What if we have very weak government and the need to do fiscal tightening? We've seen it in Argentina. They can't implement fiscal tightening. So while my response to the Great Recession was a call for monetary easing in the US and in the Eurozone, and I think that The ECB's rate hikes in 2011 was a primary cause of the euro crisis that played out in 2011, 12 into 13. This time around, that's not the case. This time around, the cause of the problems is not directly monetary for those countries that are now in the spotlight. Turkey's problem is not monetary. Turkey's problem is that Erdogan, after 1.5 decades of fiscal consolidation, has allowed fiscal easing. That means that public finances in Turkey increasingly unsustainable. And we are seeing the same thing in Russia. We are seeing the same thing to an extreme degree in Brazil. Argentina, the credibility of the fiscal consolidation is clearly being questioned. So the answer for emerging markets now is not monetary easing. It's fiscal consolidation, it's growth reforms to spur growth. But then on top of that, obviously you can do monetary easing to offset any growth impacts on the fiscal consolidation. But just monetary easing on its own will not solve this problem, because you're already in the long run, so to speak. So in many ways, the solution is less obvious than it was for the Eurozone or for the US. Don't get me started on US debt problems, because I think that the US in some ways look like this, and fiscal consolidation will have to take place in 2020, 2021 in the US. That's one of the reasons why I don't think the Fed funds rate will anytime soon get over 3%. But it's challenging, because some of these countries where you had a very long period of good luck, Vladimir Putin still in power, still quite popular, World Cup taking place in his beloved Russia, he's facing fiscal challenges. So is the Brazilian government, so is the South African government, so is the Argentine government, so is the Turkish government. They are essentially all in a situation where relatively large fiscal consolidation is needed to avoid currencies continue to weaken very dramatically. And it's not about speculative attacks on these currencies. It's not about these currencies suddenly being everybody just dumping these assets. No, it's simply about the fact that interest rates now have moved slightly above, and somewhere, for example in Brazil, way above threshold levels. That means that suddenly public debt is no longer sustainable. And you get this negative debt dynamics that fundamentally cause debt to spiral out of control, unless it's offset by either fiscal tightening or much easier monetary policy. But once you try to solve fiscal problems caused by irresponsible fiscal policy with monetary policy, then you get a problem. That's the extreme version of this, of course, is Zimbabwe 2008, or Venezuela today, or Argentina back in 2010, 11, 12. I don't say that Turkey is there. I don't say Russia is there. South Africa is there. I don't even say that Brazil is there. But it's very clear that these countries need significant fiscal consolidation. And that could mean politically for those presidents who have been ruling their countries for a long time, that they could be facing significant political headwinds that they haven't seen in decades. I'm sure Vladimir Putin will know that. President Erdogan will know that. And obviously that's playing out everywhere else where we have this. The situation in Brazil and Argentina is a very clear illustration of just how hard it is to consolidate public finances, even though it's badly needed. So yes, monetary easing was the main solution for the unfolding of the debt crisis in Southern Europe, because the collapse of nominal GDP was the main cause that triggered the problems in these countries. Monetary easing was a very large part of the solution in terms of the US to stabilize nominal GDP growth. But one decade after that, if your public finances are still unsustainable, while at the same time you have trend growth and your inflation target is on target, then the solution is not monetary. So there is no, the fact that US debt levels continue to rise, there's not a monetary solution to that when inflation is more or less on target and we have above trend growth, real GDP growth. Then you need to have fiscal consolidation. The US will face that within the next 2-3 years. And for the large emerging markets, that time might be right now. So it might be that Vladimir Putin is enjoying the World Cup in Russia, but he should really begin to worry about what will happen to Russian public debt, or what have happened. Obviously, can be saved by higher oil prices, but there is a limit to how lucky you can be. And I think that goes for many rulers in large emerging markets, that they might be running out of luck. Thank you very much.